In this morning's Business Insight, Tax Day is less than a month away, if you can believe it. The big news this year, of course, is the new tax law. Though it doesn't really affect the taxes you're filing now, there is quite a bit you should know to get ahead for next year. Jamie Smith is back with Chuck Stevens, a partner at the accounting firm MCM, who breaks some of it down for us. Gentlemen.
Thanks, Peg. Chuck, thanks for being here today.
Thanks for having me.
Now, obviously, tax time is a little stressful for business owners as well as individuals. Talk about some of the changes that we should be aware of this year.
Sure. It's also stressful for us tax accountants. But yeah, on the business owner side, we really just had some of the most sweeping tax changes since the '86 Act. And so a lot of different areas that are affected, so I'll just highlight a few. But for business owners that operate as pass-through entities, so that can be a partnership or an S corporation or even a sole proprietorship, we have a new deduction called a QBI deduction, or qualified business income deduction, that amounts to 20% of the income from that pass-through entity. Now, like a lot of tax laws, there are a lot of asterisks after that, right? So there are different limitations that apply depending on your taxable income. So if you're above a certain threshold, you may not qualify unless you meet certain wage amounts, or if you're a specified service business, you also may not qualify for that deduction.
So it's not a gimme. You've got to meet some qualifications.
That's right, yeah. But overall, the effect would be that pass-through income is only taxed on 80% of the profit, which is a pretty big deal.
That's good news then.
It is good news. On the C corporation side, rather than having this graduated rate structure like we've historically had with a top rate of 35%, which was one of the highest in any industrialized nation, we're now with a flat 21% corporate tax rate. So every dollar earned by that C corporation is taxed at 21%. So pretty significant spread between 35 and 21%. So one of the things that you'll want to look at if you're a business owner is does it make sense to remain as a pass-through entity, or does it make sense to maybe switch to a C Corp in light of those changes?
Right.
Yeah, and you need to really get out your crystal ball for that, because there are short, intermediate, and long-term considerations in that. That's right.
Where you go, right.
Some other highlights on the business front are bonus depreciation. So for qualifying property, this is capital expenditures, you get to deduct 100% of the cost of those in the first year, which is a significant savings. And that actually is one of the few areas that applies retroactively to anything purchased after September 27th.
Oh, wow.
So it could affect your 2017 income tax return. And a new thing to remember about bonus depreciation is that it now applies to used property. Before it had to be brand new. Now it's just new to you. So used property now qualifies. On the flip side, that's a big savings. On the flip side, there are potential interest expense limitations going forward. So before, a business could deduct all their interest expense. Now that's going to be limited to 30% of what's called adjusted taxable income if the business has more than $25 million of gross receipts. So a lot of different changes there.
Well, three of them sound like they're positive.
That's right.
We got about a minute left here, but quickly, how about on the individual basis?
On the individual side, we have overall rate reduction for each of the 7 brackets. So the top rate went down from 39.6% to 37%. The old personal exemptions where you claim yourself, your spouse, your kids, that's gone away. The standard deduction has effectively doubled to $24,000 for married couples filing jointly. And then on the itemized deductions, a lot of different limitations, including a big one around here is your state, local income tax plus property taxes can't exceed $10,000. You get a maximum $10,000 deduction for those.
Wow, that's good. Anything that we should leave the viewers with?
Yeah, sure. One of the things you can still do to have it retroactive to 2017 are retirement plan contributions. So if you have a retirement plan contribution, it's possible to still fund that up till the due date of your tax return and count it against last year. And if you think you're going to be in a higher rate last year versus this year, it may make even more sense to go ahead and apply that retroactively.
Well, thank you so much for all your insight. It's good to hear some good news in there. And I hope you're going to enjoy some basketball during the weekend. I know it's hard for you tax guys.
It is. We'll do what we can.
All right.